Yeah, that was the end of question 3 2024. So I'm going to skip question 4. I think I'll come back for it later. So we're going to proceed to question 5, which is the last question of 2022 paper. So in question 5, we've been given two comparative years, that is income statement and statement of financial position for two comparative years, in which we were asked to calculate the following ratios listed down. Okay, so in this case, I'm just going to do one side, since we've been given two comparative years where you are given to calculate ratios of this year and also ratios of the other year. The 2 years which have been given, in this case we have 2021 and 2020. So I'm just going to do 2021 ratios, since it's the same formulas, the same things that we're going to apply to 2020. So I'm just going to do one of them. Yeah, so in our first question, the first question is asking us to calculate gross profit margin. The first question is asking to calculate gross profit margin, and the gross profit margin is equals to the gross profit divided by revenue times 100%. That's the formula. So with this topic, you're just going to get figures direct. So in this case, our gross profit, so I'm doing 2021, then for the other year you can still do it since it's the same things that we are doing. So gross profit, in this case our gross profit was 1815. So gross profit is 1815, and our sales or revenue is 38. So that figure divided by 3,800 times 100%. So we have 1815 divided by 38 of that figure times 100, which is giving us a 47.8. We're going to get one from there. I'll put it that side. We're going to have 47.8. Okay, so our gross profit margin is going to be or just 48. So 47.80%. That's all. If we're doing for the other year, again, we're going to calculate the gross profit margin for the other year, in which we're going to get the gross profit for the other year, which is 2020. In this case, gross profit was 220.42 divided by our sales revenue, which is 3,700. The figure we're going to get multiply by 100%, then we find the figure for 2020. So that was for gross profit margin. Next in the question, we have operating profit margin or net profit margin. So operating profit margin is equals to the profit. Okay, I can still be using abbreviations. Profit before interest and tax divided by revenue times 100%. So going back in the question, profit before interest and tax is 415. It is 415, and our revenue still remains 3,800, since we are doing 2021 times 100%. So we have a 415 divided by 3,800. The figure that we have, we're going to multiply by 100%, which is going to give us 10.9. So this is 10.9%. We are done. Next in the question, we have return on capital employed. So return on capital employed, what we call ROCE, is equals to profit before interest and tax divided by capital employed times 100% as well. So profit before interest and tax still remains 415. Then on capital employed, we know that assets is equals to capital plus liabilities. We can divide assets to be current assets plus non-current assets is equals to capital plus current liabilities, that is plus non-current liabilities. We're trying to split this one and this one. Yes, so for capital employed, in order for us to find the capital employed, which simply means the current liabilities has to go on the other side. current liability figure has to go on the other side, which simply means this current liability is going to come this side. We're going to have our current asset plus non-current assets minus, since it was a positive figure, when it crosses the equal sign it's going to change to a negative figure, so minus current liabilities. This is equals to capital plus non-current liabilities. So current assets plus non-current assets minus current liabilities equals to capital plus non-current liabilities. We've just gotten this figure and taken it that side, which is no wonder it's having a negative, which simply means the figure we're going to ascertain here is our capital employed. Since there's an equal to sign, which means even this side, the capital plus non-current liabilities also has to give you the same figure, which you can still call capital employed. So to find capital employed, we said we have current assets. So in this case, we said current assets plus non-current assets. So current assets we have this total here, non-current assets we have this total here. Non-current assets plus current assets is giving us this figure here, that is for 2020. So total asset, that is current asset plus non-current asset, is 3122 minus current liabilities, since that is current asset and non-current asset, which is giving us that, which has already been calculated for us. Then we're just subtracting current liabilities, and in this case our current liabilities have equity and liabilities, of course. So all these are equity, non-current liability. Okay, current liabilities are 122, so we're subtracting in the 122, which is going to give us 3000, as our capital employed. So times 100%. So we have a 415 divided by 3000 times 100%. This is giving us 13.8%. We're done with the return on capital employed. Then next, this was our C, D here. Next, inventory days. So for inventory days, it is average inventory or stock divided by cost of sales times the number of days. Okay, times number of days. So our average stock is talking of, we add opening stock plus closing stock. The figure we're going to get, we divide by 2, that is average inventory. Okay, that is our average inventory. So in our case, our opening stock was okay, we don't have information for the opening stock, so we're going to use our closing stock. Since it is just 1, we will no longer divide by 2, but if I had our opening stock, we're supposed to add the opening plus the closing, then divide by 2. So in this case, we just have the opening, so we're going to use, we only have the closing, so which means we're going to use that figure as the way it is. So we have 300 divided by cost of sales. In our case, our cost of sales figure is 1985, so divide by 1985 times total number of days, which is 365. So we have a 300 divided by 1985. The figure of ascertained, we are going to multiply by, okay, yeah, so we have 300 divided by 1985. The figure of have, we're going to multiply by 365, total number of days, which is going to give us 55.1%. okay, that was D, which was inventory days. Next, I'm going to use the other page. Next, we're asked to calculate, I think we're going to use this page. Okay, next we're asked to calculate trade receivable days, which is E. On E, trade receivable days. So for trade receivable days, it is debtors divided by credit sales. We're supposed to write credit sales. Of course, we're going to use sales, but someone has to indicate credit sales, multiply by 365 or number of days if they are there. Okay, so our data is in the table. Data's receivables were 312. So data's 312 divided by credit sales. We have used credit sales because that was the formula. What's the formula talks? But then in our case, we're going to use credit sales. Sorry, we've written credit sales, but we're going to use sales because we don't have any information on goods or assets which were sold on credit, or stock which was sold on credit. So we're going to use our revenue. In the formula, someone has to write credit sales, but they are going to use sales figure. Okay, so our revenue was 38. So times our 365 days. So if we do that, we're going to have 312 divided by 3800 times 365. Therefore, we're going to have 29.9 days. Okay, next we're asked to calculate trade payable days, which is F. So on F, we're asked to calculate trade payable days. So on trade payable days, same applies. We're going to have our creditors. We're going to have our creditors divided by credit purchases, but we can still write as purchases, times 365 days. So if we do that, our creditors in here, our creditors were 100. So we have 100 divided by purchases. Our purchases, we don't have purchases information on purchases, so we're going to use our cost of sales. So our cost of sales was 1985. So times 365. So if we do that, we have 100 divided by 1985. The figure that was attained, we're going to multiply by 365. So this is going to be 18.4 days. Okay, that was F. On G, we have current ratio. G, we have current ratio, in which you know that on current ratio, we have our current assets, which we are going to divide by current liabilities. Is to 1. So our current assets total was 812 divided by current liabilities total was 122 is to 1. This is to 1 is not doing anything except just there to represent that our current liabilities are going one time in our current asset in order for ascertain the figure that we are going to ascertain. So we have our 812 divided by 122, which is giving us 6.6. We can get a 1 from here, it's going to be 6.7. So this is going to be 6.7 is to 1. Okay, so yeah, that was our current ratio, which simply means for every one quarter that the business is owing, there is 6.7 available to pay. Okay, then that was G. That was G. H is an acid test ratio, acid test ratio. Okay, this one is simply our current assets. Of course, we're now going to remove stock or inventory, divided by the same current liabilities. So it is the same formula. It's quite related to current ratio, except in here now the business has realized that because this one is talking about how much are we going to pay in case the people, our creditors, come for their money. So in here we're saying, since for the money that we are owing, there's 6.7 to pay because our assets are higher than our liabilities. But now this here now they're trying to analyze that in the current assets which you said to be higher than current liabilities. In the current assets there's stock. Stock is goods that are ready for sale. But now if our creditors come for their money, we'll not be able to give them all the stock, the goods. These people demand for their money. So we're trying to remove in the stock so much that we see how much is going to be available in case our creditors come for their money. So we're going to remove stock. So our current assets, like it was already calculated, which is 812. Now we're going to remove our stock. So our stock, going back in the question, our stock was 300, so we're going to remove the 300. Then the figure that we're going to remain with, you're going to divide by current liabilities, which has not changed, which is 122 is to 1. So this is going to be our 812 minus 300, which is 512. 512 divided by 122. Okay, so this is going to give us 4.2 is to 1, which simply means the business is still doing very much okay, because if the creditors come for their money, for every one kwacha that the business is owing, there is 4.2 kwacha to pay, which means the business will still be able to operate even after the creditors come for their money. So that was asset test ratio. Next we are going to the last two ratios, which are interest cover and earnings per share. So for interest cover, this is I. Interest cover is simply profit before interest and tax divided by interest itself. So profit before interest and tax as well. Profit before interest and tax is 415. So we have 415, and our interest was interest payable, it was 185. So we have 185. So we have 415 divided by 185. This is 2.2. Okay, that was for interest cover. Next, J, we have earnings per share. Earnings per share. Okay, earnings per share is our profit after interest and tax, or what we call profit for the year, divided by ordinary shares. So with this, you just have to master the formulas, because formulas are a lot. So our profit after interest and tax, which is profit for the year, in this case it was 184. So we have 184 divided by our ordinary shares. Ordinary shares was 1,000. So we have 1,000 times 100%, of course. So this is going to be simply 18.4%. So we're done with the question E. This was what? Oh, this was question 5 part A. So we are going to the next part, which is question 5 part B. Okay, so question 5 part B, we're going to do it from here. So for part B, you're saying the following trial balance was prepared by a fresh graduate in accountants and failed to agree, and the difference was posted to the suspense account. Okay, so there's a trial balance which was prepared, and then the trial balance did not balance because of the errors which have been identified down there. So the question is asking us to prepare Journal entries: number 1, clear the suspense account and prepare a corrected trial balance. So we have 3 things to do there. You have to prepare the journal entries, then how we are going to prepare the suspense account. From there, we're going to transfer the information back into the trial balance in order for it now to balance. So for journal entries, we're going to prepare them from here. Journal entries, we're going to prepare them from here. Here we have to be mindful with the errors and how I'm going to be correcting them. So we have different types of errors. All errors affect the trial balance, but there are errors that affect the agreement of the trial balance. Some errors, even when you commit them, you're going to realize that the trial balance is going to balance, though with wrong figures, but the trial balance is going to balance. But there are some errors in which if you commit them, the trial balance will not balance. We're going to have different balances. So there are different types of balances, different types of errors. There are errors which affect the agreement of the trial balance, and the errors that do not affect the agreement of the trial balance. Errors that do not affect the agreement of the trial balance, even when you commit them, the trial balance is still going to balance, except with wrong figures. But errors that affect the agreement of the trial balance, immediately you commit them, it will not balance. Okay, so let's go. So for journal entries, we have our details column here, then we have our debit, credit. So we're going to start with the first. Excuse me. Okay, we're going to start with the first error. So they're saying an invoice to G Peter on credit for 125 was completely omitted from the records. So this is an error of omission. An error of omission, if you omit an error, which simply means you've not recorded the transaction, and every transaction has two accounts, which means there's a debit and credit account. Now if you omit, which simply means you've not entered the transaction in any of the accounts, which means that balance will be showing, will be a shortage on the credit, and this still be a shortage on the debit side. So if you omit, to make an error of omission, which simply means the trial balance is going to balance except with the wrong figures. So in this case, they're saying a sales invoice to G Peter. So it is a sales invoice to G Peter. So which simply means Peter was receiving, it was a sales. So which means we're going to debit our Peter who is receiving and the credit sales, since sales is a credit entry. So we're going to debit Peter, debit with the same amount 125, then we credit our sales. The suspense is not involved with the same amount. So we are done with the first entry, with the first error. Next, a payment of 52 by bank for electricity was wrongly posted to the debit of purchase account. Was wrongly posted to the debit of purchases account. So in this case, they're saying a payment of 52 by bank for electricity, it was wrongly posted to the debit purchase of account. So it was a electricity, they paid for electricity. What they did now, they had to debit purchase account. This entry was not supposed to enter in the purchase account, and you know that purchase is a debit entry. So if they posted it on the debit side, which means it doesn't belong to the purchase account. In order for us to remove it from the purchase account, we are going to credit purchases, and the debit was supposed to belong. In this case, it's supposed to belong to electricity. So we are simply going to debit our electricity and the credit purchases with the same amount, and no suspenses is involved. So it was a 52 kwacha, still a 52 kwacha even here. Then we close. We're done with this one. Next, they're saying purchases were undercast by 198. So an undercast is one of the areas that affect the agreement of a trial balance, because if you undercast, which means when adding up the total you're supposed to get, let me say you're supposed to get 1,000 and then you're coming to get an 800, which means that side where you have committed that mistake, you are going to have a shortage. The other side is going to be okay. At the end of the day, the balances will not be able to agree. So if you commit that error, it will not, the trial balance will not agree. So there's an undercast, which means there's a shortage of purchase side in purchase debit entry, and there's an undercast of 198, which means there's a shortage of 198. So since purchase is a debit entry and there's a shortage, you're still going to debit it in order to make it balance. So purchases, the undercast, which is 198, we're going to debit it. And since this error affects the agreement of the trial balance, we need to involve the suspense account. So the other account which is involved in here is suspense, which is going to be having the same amount as well. Okay, last but not the least, we have the sales. They're saying the sales were overcast by 100. Sales is a credit entry, and if it was overcast, which means sales is a credit entry, on the credit side there is more than the amount which is supposed to be there on the credit side. So to correct that, to remove that from the credit, we are going to debit it. So we are going to debit our sales with the 100 kwacha, and since this error is an overcast which affects the agreement of the trial balance as well, we are going to credit our suspense account, which is the other account involved, of 100 kwacha. So that marks the end of the journal entries. That marks the end of the journal entries. Okay, then you have to prepare the suspense account so much that you'll be able to finish up with the trial balance. So for the suspense account, we are simply going to draw it in form of a T account. So in the question, in the trial balance that was prepared, on the debit side there's a shortage of 298 on the debit side. That's why they've written it to be 298. So we have difference in the trial balance, which is on the debit side. Difference in trial balance to be 298. Then we're going to get the information from the journal entry. So in the journal entries, we're going to get only the information where the suspense is involved. So in our case, on the first entry, we don't have any suspense involved. Second, we don't have any suspense involved except for adjustment 3. So in adjustment 3, there is suspense account. So since suspense is on the credit side, we're going to put it on the credit side, but in the name of the other account, which is purchases. So we're going to write it as purchases, but since the figure of purchase suspense is on the credit side, we're going to write it on the credit side. So this is 198, this figure. Then next as well, we have sales where the suspense is involved. Suspense itself is on the credit side. We're going to write it on the credit side while having the name of the other account, which is sales. So we're going to have our sales here, which is 100. So when you balance this out, if you have a lot of entities which were involving suspense, we are supposed to bring them. We are supposed to bring everything in here, but in the case we just have two things. So we're going to balance this up. This suspense account has to balance. If it doesn't balance, which means there's simply a mistake which was made in the journal entries. So if you add this, we're going to have a 298. Adding this up, we have a 298, which simply means our suspense is okay. Next, we're supposed to finish up now the trial balance. So let's finish the trial balance. Okay, yeah, for the trial balance, okay, so we're going to start with our sales, which is already there. Our sales was 985. Our sales was 985. Now let's not forget that there was an overcast, which means in the sales, the 985, there's an overcast of 100, which means the sales was supposed to be well, it was not supposed to be 985. It is only 985 because there's an overcast, because they overcalculated. Because I was supposed to have 100, you have a 200, which means that's an overcast. So we're going to remove that overcast of 100. So from the 295, no, sorry, from the 985, we're going to remove the 100, which simply means we're going to remove the sales of 885. 985 minus 100, we have 885, and sales is a credit entry. We'll write it that way. Then for purchases, next we have purchases. So for purchases, we are 214. So since the purchases themselves were supposed to be 214, except there was an undercast, which means they had written a figure that was below the original figure. So we're going to add back the figure, the shortage which was missing, and in our case the shortage was 198. So plus 198, if we do that, we're going to have, we have 214 plus 198, which is going to give us a 412. A 412. Then plant and machinery at cost. At cost, that one is a 200. Then accumulated depreciation. Accumulated depreciation is 50. Then trade receivables, or rather debtors, is 150. Payables are 85. Then salaries and wages, these are expenses which are found on the debit side. Salaries and wages 65. Bank 118. Cash 12. Electricity 63. So that's why I was just trying to copy the information from the question itself here, so much that if you add our debit side, it should be equal with the credit side, which simply means everything we've done is okay. So we have a 412 plus 200 plus 150 plus 65 plus 118 plus 12 plus 63. This is 1020. So the debit side is 1020, and then on the credit side we have 885 plus 50 plus 85. 885. Okay, sorry, I multiplied here. Okay, so we have 1020, and that is the last part of 2022 paper. The last part. So we are done with 2022. Next in the video we're going to have our 2024 paper, or if 2023 paper is there also, we're going to do 2023 paper, then we're going to remain with 2024, which I may upload tomorrow morning. Thank you.